The broadcast is now starting. All attendees are in listen-only mode.
Hello and good morning, everybody, and welcome to another one of our China's Digital Consumer 2020 webinars. My name is Maxime and I am a Service Delivery Executive here at CBC. And today I'm very excited to introduce our guest speaker, Maria Kotova, Head of UK and Ireland Desk at Desan & Associates. Our topic for today is how to sell to the post-COVID-19 consumer market in China. Very quickly, before we get started, as always, it would be great if you can let me know that you can all hear my voice and see my screen. We don't have the webcams on today, so don't feel like anything's not working if you can't see us. So everybody should have a panel which looks something like this here on their screen, and you will have a little hand button here. If everybody could give me a virtual hands up by clicking that button, that will let me know that everything is working and there's no problems. Yes, I see some hands going up. Okay, perfect. Thank you very much. And I've also circled here our questions box. As always, I want to encourage everybody to ask questions throughout. These will appear in this little box in front of me and we will address them at the end. So if something pops into your mind during the presentation, just type that in and fire it across. And yeah, don't be shy. Please do ask questions. And very quickly as well, a little introduction to CBBC for those of you who don't know. We are the China-Britain Business Council. We are the leading organisation supporting UK-China trade. Here in the UK, we have about 40 employees across the country, working to support a variety of industry sectors. I work on the consumer team and we support the agriculture, food and drink and retail sectors. Over in China, we have 13 offices across the country. These are across all of the major Tier 1 cities, Shanghai, Beijing, Guangzhou, Shenzhen, and also some of the second and third tier cities as well. Our wonderful China team there are working on the ground to support British businesses breaking into or developing their China market. As always as well, this is our series. We are coming to the end slowly. It's been a long haul since January and we have a lot of content online. So I think that this will probably be wrapping up at the end of this month. But we still have lots of great content for you. We've got the next one on the 10th of June. This is from Sonny Tran, the Senior Sales Manager at China Cash. And he's going to be talking about enabling cross-border connectivity on all applications, websites, and digital content for China. We'll have a food and drink focused webinar on the 23rd from ChemLinked. And then we'll be finishing off the series with a really interesting webinar all about video marketing, and that's from Catalogue. And also a little plug here, we have a free 30-minute consultation service here at CBC. If you'd like to know more about this, you can do so on the website. But without further ado, I would love to introduce our speaker. Maria is going to give you a better introduction than this, but this is just a quick insight into what we'll be covering today. So, as I said, Maria is head of the UK and Ireland desk at Desan & Associates. So the topic today is coronavirus related, and we're going to be introducing the increasing e-commerce and digital dominance in China's retail sector as a result of this, examining the best approach for overseas brands selling online to China whilst maintaining compliance and minimizing risks. And Maria is also going to go into all the important regulatory areas that you should consider, key legal and financial considerations for UK businesses selling to the consumer market in China. So without further ado, I'm going to let Maria share her screen. And yeah, welcome, Maria.
Okay, thank you, Maxime. Let me share my screen. Okay, can you see it?
Yeah, that looks great.
Yeah. Okay, perfect. Thank you again for the introduction, and hello, everyone, and welcome to today's session. How often have we raised the question on the impact of coronavirus to the trading models and consumer market? It became obvious that new normal will have significant impact on the consumer market, and today we will speak about the key considerations for selling to post-COVID market in China. So I would like to say a few words about our company to set the scene on the areas we specialize in and will focus during our discussion today. Desan & Associates was incorporated in 1992. We are one of the largest independent business advisory practices in Southeast Asia. To the date, we have 28 offices across Asia, including China, Vietnam, India, Hong Kong, Singapore, and other ASEAN countries such as Malaysia, Indonesia, and Thailand. We assist foreign businesses with market entry strategy, corporate structuring, legal advisory and establishment, as well as ongoing compliance, including tax, accounting, and HR assistance. We have more than 350 lawyers and financial advisors spread across the Asia, helping foreign businesses to navigate complex regulatory environment in the region. So today, as Maxime was already introducing, we're gonna cover several large areas in the post-COVID consumer market in China. While it is difficult to predict what the final impact of COVID-19 will be, we will try to look at the current state of the Chinese market and key considerations under different trading models. Early data in China suggests that consumers will be slow to resume to the normal spending habits, but in some areas may shift to the new normal, driven by habits that they've picked up during the lockdown, and companies should prepare to adapt to take advantage of these new business models, which we will talk about. As the recovery takes shape, several important shifts in the market follow will follow the economic landscape that have already become apparent. COVID-19 has accelerated pre-existing trends. So why China continues to become one of the most important consumer markets to watch? If we look at the top 6 household consumptions, by 2028, China's consumer market will grow for more than 117%, which is a double of other markets' potential. Being the second country in private consumption, China's urban population disposable income will be projected to grow significantly, up to $30,000 by 2030. Although projection will have the impact of COVID implications for sure, still there is a huge purchasing power on the Chinese consumer market. It is anticipated that the global economy will shrink by 3% this year and partly rebound in 2021. While advanced economies and emerging economies of G20 are predicted to contract by almost 6% and 3.5% respectively, there are only 2 economies actually that are predicted to have a minor growth. It is China and India. China is expected to grow by 1% in 2020 and about 7% next year. In the first quarter of 2020, the spread of COVID-19 in China led the authorities to introduce a range of measures to control it. This included travel bans, business closures, and quarantines that substantially disrupted trade. There are several characteristics that deserve attention. Imports and exports fell by 6.4% on year-on-year basis for the first quarter, and decline was not actually as bad as we expected. Imports and exports improved in the month of March already, as the businesses started to get back to normal. It is also important to point that it is actually for the first time that ASEAN replaced EU to become China's largest trading partner. The Brexit factors of the UK were superimposed. If you look at the trends and demands, COVID-19 has accelerated pre-existing trends. China has 20% of the world's population, but just 5% of the world's arable land. So China is energy and water poor. Huge consumption market, incomes rising 8% nationwide. Consumers have funds to save and spend. Spending will grow on health-related areas such as healthier foods, exercise activities, medical expenses for themselves and elderly relatives. If China does not secure food and energy suppliers to keep it or keep its population content, the implications are very serious. So Belt and Road is actually the answer to that. Greater Eurasian Partnership continue to develop and will link the Eurasian Economic Union Belt and Road and ASEAN. This means import, export, and service opportunities that will increase, and we can deliver goods from ASEAN to the borders of EU or UK customs free. Other trends that particularly accelerated during COVID-19 include different areas. For instance, there's a huge impact on the value chains. So due to the complex nature of global value chains, China has been one of the largest players in them. The pandemic started in China has created the disruption to the global value chains, which have been already under the pressure due to China-US trade war. Firstly, the decline in production and trade due to initial lockdown in China led to a strong impact on countries further up and down the supply chain. Industrial production dropped by a little bit more than actually 8% in Q1. Further, although China started to gradually recover, the lockdown spread across the globe, and as a result, there is a significant drop in demand. However, COVID-19 impacted firms unevenly. Some businesses, for instance, those supplying technology used for auto or aircraft, face steep declines in demand. Others, like producers of entertainment products, such as video games or other systems in the entertainment sector, are actually seeing increasing demand. Due to the serious supply chain problems in Asia, many realized their need to restructure complex supply networks to make them more redundant. Those who needed to find supplies abroad to compensate for production that was suddenly frozen in China were exploring the opportunity of bringing their production back to China, back to their home countries, or maybe consider other locations. If they were considering moving it back to their home country, it's likely to increase the cost and inventory. So China Plus One strategy was the one that was implemented by many. And Google and Apple, for example, were among leading companies that accelerated efforts to relocate parts of their production from China to Southeast Asia. Other trends include e-commerce made in China 2025, which is a hub for advanced manufacturing, digital economy transformation are the major post-COVID trends that were impacted and continue to impact the economy. So we would look into those three a little bit more in details. So here we are going to look in the digital economy in China and what is the basis for that. So many of you probably heard about Made in China 2025. It's China's bid to define global manufacturing. It caused a stir when it was launched in 2015, but that 10-year program is actually just the tip of the iceberg. It is not a standalone project. Rather, it provides the positioning for the next bigger move, a program to define the rules of global production and exchange, China Standards 2035. With China Standards 2035, Beijing intends to set the foundational rules that will define next generation technologies for telecommunications and artificial intelligence. The idea is that we are entering the era where we will be defined by the new technological systems and networks, but the leaders in those are yet to be determined. And this gives China the opportunity to determine that. China plans to participate in the formation of international standards that will be further linked with Silk Road Initiative to build one digital ecosystem. Such crucial future technologies as Internet of Things, cloud computing, 5G, and artificial intelligence are the main focus. COVID-19 has not only accelerated digitalization in business to consumer applications and channels, but also the traditionally less digitalized parts of the economy, such as areas requiring physical interactions and business-to-business processes. Before COVID-19, China was already a digital leader in consumer-facing areas, accounting for 45% of global e-commerce transactions, while mobile payments penetration was 3 times higher than of the US. Consumers and businesses in China have accelerated their use of digital technologies as a result of COVID-19. Based on the recent surveys that was held among companies in China, Chinese consumers are confident about 55% will continue buying all of their groceries and other products online, even after the crisis, after the COVID-19. So working practices also changed significantly. Enterprises, communication platforms, revenues are growing. It's actually doubled during this period. In healthcare, digital interactions accelerated as well. The rapid growth of online consultations, partly thanks to the regulatory shifts in reimbursement policy, as well as broader virtual interactions between pharmaceutical sales agents and physicians. These changes occurred ahead of wide deployment of 5G technology, which will likely catalyze the use of digital tools. If you look at the e-commerce side, in May this year, it was announced that China will establish integrated pilot zones for cross-border e-commerce in 46 cities and areas. So far, China has provided 5 batches of about 105 pilot zones since their first pilot zone that was actually set up in Hangzhou in 2015. So the new zones will expand China further to Midwest region and beyond. Enterprises can avail of preferential tax policies such as exemption of value-added tax or consumption tax on retail exports, or reduction of corporate income tax rates in cross-border e-commerce pilot zones. As the new form of business in the development of foreign trade, cross-border e-commerce is expected to play an even more important role in stabilizing China's export trade in light of recent trade frictions or even decoupling with the US. Moreover, local governments to assist enterprises there to jointly bid and actually share overseas warehouses established for in the foreign countries as a bulk storage of the exported goods and directly delivered from to the country after the consumer purchases it via online platform. E-commerce will further outperform retail in the year ahead. So what are the trends that will shape post-COVID e-commerce market in China? Well, live streaming will play a bigger role in e-commerce in 2020, as it enables brands and retailers to market their products to consumers in real time and offer consumers the advantages of limited time discounts. It is expected that e-commerce landscape to become more diverse, and short video platforms embracing e-commerce and mini programs providing retailers with technologies such as augmented reality to further engage with potential customers. On the demand side, consumers are placing increasing importance on sustainability and are therefore likely to shop through e-commerce platforms, which are the platforms where you can actually buy second-hand products. Vertical marketplaces offering engagement opportunities to shopping communities will also increase. Group buying habits will become an efficient method for retailers to reach consumers from lower-tier cities in China, as it offers products at relatively low cost. So back to the trends, demands, and threats. Now we're going to look into the threats and what are those in post-COVID-19 market. Well, obviously, unemployment is the major concern right now. The government is considering different measures to help and improve business situation and to reduce the unemployment rate. It is currently in March, it was slightly up to 6%, and in 2019 it was 3.8. So there is still a lot of space that to improve. The speed of economy recovery from COVID creates the uncertainty and concerns for the businesses. Regional disparities in the South China Sea and Hong Kong protests, aging population, which is not new, decline in healthy industrial sector, property bubbles, growing debt levels, continuing environmental pollution, and also trade war that is getting worse and worse. China also pre-established this year a national treatment and a negative list management system. For those of you who are not familiar with the negative list concept, it combines restricted and prohibited industries for foreign investment. National treatment, however, will have an equal treatment for the foreign and domestic companies. So more sectors have been opened up for the foreign investment every year. Under the latest negative list of 2019, it was reduced from 48 items to 40 this year, with openings in transportation, infrastructure, agriculture, manufacturing, culture, and so on. So we look at the major sectors that will benefit as a trend, and of course, technology is one of the top among them. If you look at the technology playing the key role in the pandemic, it will continue to have the significant impact on post-COVID market, particularly on digital retail. Here you can see at this picture, we summarize some of the key sectors under technology that provide significant opportunities, and we see increased interest, and we get a lot of inquiries actually for establishment or entering those sectors. A new foreign investment law that came into effect on January 1st defines the actual control of the domestic companies targeting VAE companies in tech sector, which raises more and more concern for those who operate under such structures. It also addressed technology transfer and IP protection issues, since China has been criticized for the lack of protection in this area that needs to be addressed. However, many of the restrictions for the foreign investment entering specific sector exist, and you can see again here just a brief snapshot that you need to define very properly the business model to eliminate unnecessary licensing requirements and being able to enter the market in the niche where you want to be. Some of the tax preferential treatment still exist for the technology companies. It's actually been in place for a while. So those of you who operate in this sector looking into entering should probably look into qualifying for some of those reduced tax rates. Next, if you look at the post-COVID market behavior, you can see that post-COVID consumer market shows that consumers adopting more rational spending mindset, become more prudent, seeking for better quality, eco-friendly, and healthier options. Healthcare spending is expected to account up to 7% of the total GDP in China by 2030. So China's healthcare market is growing and became one of the most attractive in the world for foreign investors due to its size and growth. China surpassed Japan to become the world's second largest healthcare market and continue to develop as fastest growing healthcare market of all the large emerging economies. Recent reforms in medical device sector and registration continue to encourage foreign businesses operating medical devices to bring their products to China. Moreover, such sectors as advanced medical technology, management, experience, best in the industry operational models, and some specialized services like nursing, hospice are actually in high demand and encouraged by the government. Clean energy and clean tech will continue to be the trend in the post-COVID China market. High-tech manufacturing with new technologies will have a higher chances to be approved comparing to the traditional production plants. Chinese investment into green industries will continue to increase. At present, China has the highest capacity for renewable power production, as it holds a quota share in the global capacity of renewable energy. Wind and solar power are the backbone of China's renewable energy sector and are the highest in the world in terms of capacity. China became the world's largest and fastest growing market for new renewable vehicles. Next, we are going to look into different business models for selling in China from the technical perspective and from the key considerations of pros and cons. And this will include selling online through the direct sales. You may do it through the distributor. You may consider e-commerce platforms, or potentially you may look into setting up your own subsidiary and do it on the ground, selling in China, which will be another different model that we will look into. So first of all, everyone who is looking to start any interactions with China market should consider to register a trademark in China first. China has first to file system, so although it may take about a year to complete the registration, your trademark is safe if you were the first one to file. Importantly, the latest trademark law is prohibiting bad faith trademark filing. So technically, you can revoke your trademark in case someone was trying to register it on your behalf, although the process is in practice it's first of all new and complex and probably takes several years to do that. So suggestion for everyone who is looking to start anything with China, first consider to register your trademarks. It is recommended to register brands in both English and Chinese, as well as any logos and trademarks. So if you look at the first model where we are discussing online direct sales, the model is pretty straightforward. Like, for instance, you have a British supplier or going to sell directly to the customers in China. There are advantages of this model. There is no cost for the Chinese operations. It is relatively simple business model. However, you will have no footprint in China. You will have no presence, legal presence in China. You may have issues with actually selling from overseas because some of the websites are actually banned in China. You may have issues with website connectivity. Many of you may heard about China firewall. So in case your website, which is hosted abroad, is not functioning well, it is very hard for you to actually reach out directly to the audience and sell directly. Your customers will be actually liable to pay VAT on the import and customs duty, so you're shifting the burden to your customers under this model. You cannot receive RMB, so they will need to consider paying you in overseas currency abroad, and you won't be able to issue any invoice to them, ultimately Chinese invoice. And one of the key issues that you won't be able to hire local staff, Chinese or foreigners, without legal entity on the ground. So if you need someone to help you to develop sales channels and do some running and maybe post after sales support, it will actually be very hard to do. And if you do have people on the ground without registration, you're ultimately creating a permanent establishment for your headquarters, which means that the Chinese government may impose taxes if they stipulate that you have a PE in China. Lack of control for the product delivery, naturally. And of course, customer will handle all the logistics. And as a trend of post-COVID-19 consumer market, contactless delivery is actually expected or in high demand in China. So you may not be able to arrange the delivery method that will be preferred by your customers. And again, that might have impact on your sales. Another way of actually working and selling to China is looking to work with a distributor. So your Chinese headquarter, your British headquarter might find a distributor, and then you sell it to the distributor. You have an agreement, a distribution agreement with this distributor in China, and then your distributor takes the care of your customers in China. So there's a positive side of it because, again, there is no cost for your Chinese operations. You can expand your sales without any upfront investment. The distributor will have to deal with all the post-COVID-19 consumer market trends, such as digitalization, and the consumer will have to actually choose the distributor that they prefer. So the distributor will have to improve their digital presence in China, and all this cost actually not your burden. The supplier only needs to monitor accounts, and you don't have to deal with each individual customer in China. Your distributor, again, handles all the logistics, and you don't have to do anything. But on the other hand, you may lose control on the activities of the distributor. It may be very limited in loyalty, and it's not necessary having the interest to satisfy your end-up customer. The distributor might have different brands. It may represent several companies, and if your brand is not the top, the sales are not the highest, it may spend less time on promoting your product or actually putting it up front of the customer, just naturally to focus on the brands that deliver more revenue to them. So it's very tricky situation to actually allow your distributor to decide the fortune of your brand in China. You will have, again, no ability to hire anyone in China on the ground to monitor the work of the distributor, so you can only maybe travel to China, which, as you can imagine, is not very popular recently. So again, you cannot receive renminbi or invoice them in renminbi. It will be a question of who is handling the marketing and how it's done, how your brand is positioned, whether it needs to be done in Chinese or it needs to be done in English. Some of the distributors, for instance, we've been dealing with without any approval from the headquarter, put the brand on different platforms to boast it. Maybe some of the distributors even registered the trademark. We saw these cases as well, without actually notifying the headquarters. So there is all these risks that you need to take care of. And again, the distributor may ask for the exclusive rights, but at the same time you may not be the only brand that they represent. So you are kind of stuck with the distributor that you may not be happy with. Another model that we want to cover is actually e-commerce, which is the most popular right now. And e-commerce is the model that basically serves as a test platform or for companies who are looking to enter China but are not yet sure whether the market is there. They want to maybe test it and try to sell it online first. So e-commerce actually will further outperform the retail in the year ahead. And there is a new e-commerce law that was issued last year that defines the basic rules for the sales of goods and provisions of services via internet. E-commerce, in fact, is a very important area to understand properly. There are two types of e-commerce platforms. There are, for instance, the most popular one like Tmall or JD. So you need to understand that Tmall Global is not the same as Tmall China, same as JD Worldwide is not the same as JD China. And there is a crucial difference there. So if you are a foreign brand that has entity abroad, say in the UK, and you are trying to enter the platform, but you don't have any legal entity in China yet, you just kind of test the ground, you can try to enter global platforms like Tmall Global, JD Global, For that, you would need to provide your business license of overseas entity, your trademark registered abroad. But at the same time, the traffic under the global platforms is much lower compared to the Chinese platforms. So naturally, everyone is trying to get actually to the Chinese platforms like Tmall China or JD China. And this is actually the trend. It's harder to get to those platforms, but you may not have enough traffic at the global platforms, and you may not yet actually test it properly because the traffic will be much smaller. You should also know the differences. There are all kind of different platforms in China. There are B2C platforms and B2C to C platforms. So depending on your industry sector, depending on the audience that you're looking into, you may look into entering different platforms. As well, like I also should mention that if you are looking to actually entering China market and do it properly, for instance, there is a sales through the WeChat store, which is very popular right now, and it's a lot of sales going through the WeChat. You will need to have a business license in China, so you need to have a registered entity. If you are looking to enter Chinese platforms, you need to register entity subsidiary in China and your trademark in China. So there are different types of the of how you can enter those platforms. You can have a flagship store. You can sell directly to the platform. All those different activities or different types of how you operate under the platform will require additional marketing costs, digital marketing costs. So for instance, if you are trying to set your own flagship store, you will definitely need to consider quite a lot of budgeting in your initial setup for running this store, so that you can have a team who will ensure backup and kind of respond to the customers. Same with the simple marketing online. So all this online activity actually adds a lot of cost to run, and sometimes it's much higher that we see. Like sometimes it's actually triple of your initial setup cost to run your flagship store. So it's not cheap. Plus, you will need to find. You can't just contact their platforms directly. You will need to find a trusted partner who are the representatives of this platform. So they will look at your brand and whether they want to bring you on the platform. So it's not necessary that that if you are willing to get into Chinese platform, you can do this immediately. The key consideration for the trusted partners for these platforms, they want the brands who are in high demand in China. So if you are globally very popular, but in China you have zero demand and nobody knows your brand, they will be less interested in bringing you to the Chinese platforms, and you may not get access directly or immediately. You may need to build the brand first. So there are people who specialize on that, but in short, you need to have the brand that is in demand in China to get to the Chinese platforms, because everyone wants to be there, so they are pretty selective right now. Inventory is another thing to consider, whether you are doing it through global platforms or Chinese platforms, where you have your inventory. It will have a significant impact on the delivery time, and customers in China wants everything very fast, basically tomorrow. So if you're selling from overseas, you may consider to put your stock somewhere on bounded areas or somewhere else, just to reduce their delivery time. And a lot of customers won't actually order if they see that the delivery time is too long, and the competitors might provide it much faster. Another consideration is, of course, the technology solutions that you need to put in place. By technology solutions, I mean ERP systems, logistics management systems, inventory systems, all those systems that will have to deal with very huge number of online sales. The value per transaction will be pretty low, but the amount of transactions will be huge. So if you used to work offline or you didn't have that many online sales, and your system, like your accounting system and maybe management of your inventory, supply chain management systems, were pretty basic, here immediately you can grow in hundreds of thousands of transactions, and you may not have a proper system in place from the beginning. Then you will have a mess, and ultimately you will end up with issues with your financial reporting or delivery to your customers and so on. So proper technology systems to actually allow you to scale when you sell online is actually critical. Okay, and another final model that we will look into is selling through the local subsidiary. So pretty standard structure. Your headquarters sets up the subsidiary in China, and your Chinese subsidiary is going to serve to your customers, is going to sell to your customers in China, whether it's a services or it's a product. So it has its specialized structure. It's called foreign invested commercial enterprise, which is dedicated to actually provide trading, online sales, franchising, and other trade-related activities. It has the ability to actually serve as a liaison office as well. So it represents the headquarters. You have a local footprint. You can put it on your website, and Chinese customers appreciate that you have a local footprint as well. You will be able to actually put your local website, so you can apply for ICP filing if you are going to sell through your website your own goods. You might be actually doing register your website in China, so there won't be any issues with connectivity and cross-border internet. You can link it with the wallets which are popular in China, like Jifobao or WeChat Pay, so that it's convenient for your customers to pay directly to you, and basically allow all of this post-COVID-19 trends to happen under your platform. You can have an access to the e-commerce platforms in China, Chinese platforms, where the majority of the traffic is coming from. So having an entity and legal registered entity, business license, you will be able to enter those platforms. You can expand sourcing platforms yourself, logistics, quality control, so you can have actual people on the ground. Issue invoices, VAT invoices or FAPIAs in China, as some of you may have heard of that. Chinese customers appreciate paying in renminbi, and as a recent trend, everyone prefers the cashless payments, so you will be able to put in place those methods to make it convenient and easy and more accessible for your customers. You will be able to convert your renminbi into the foreign currency for the profit repatriation. Again, as I said, like local stuff, there won't be any issues. Although we see with this digitalization of the trading models, people like our customers, actually our clients, are setting up entities with less and less people on the ground. And everything is actually optimized and digitalized. It just needs several people probably to do some administrative and basic work, after sales support and so on. So this is another trend that we see. It will eliminate for you the risk of the permanent establishment, so there won't be any tax risk to be imposed for your headquarters. And later, if you feel like you are going to grow and your business is successful, you want to expand your business to other cities, you can set up branches to hire people on the ground there and maybe expand other regions in China. You can develop your own infrastructure and marketing. So again, that might be additional cost if you do it or through the digital sources. But this probably will be the trend for the post-COVID market. Everyone will continue to actually invest heavily into digital marketing. Building contactless delivery channels will be possible for you because you have the ability to actually navigate that on the ground. Comparing to the model where we use the distributor, you will be able to actually control the product and the prices that you have on the market. Protect your IP. There won't be any third parties, so it will be your own subsidiary. If you have any technology or IP in your product, you can license it to your subsidiary, and your subsidiary will be paying a royalty back to your headquarters. but at the same time, you actually have it under your group, so there won't be any potential risk. And as we've talked about this, you can put all this technology solution in place because you have the entity on the ground, and you can choose the right solution that is localized in China. So there are also some negative parts under the structure as well. For instance, the initial cost for setting up an entity, of course, will be high comparing to the previous models. You will need to rent an office. You will need to pay somebody to actually help the lawyers and financial experts to actually do the structuring and set up your entity. There is compliance cost for doing monthly bookkeeping, for doing payroll, for hiring people on the ground. So all those costs will be additional on the top of your operations. So development of your China sales operations on your own will require maybe some more sophisticated structure on the ground. So again, this is additional cost. You will need to consider how to repatriate profits. So if under the previous model, it was just directly going to you abroad, here you accumulate all the revenue in China, and you will need to consider different methods of how you repatriate profits back to headquarters if you're not planning to accumulate it in China. As I said, compliance burden, monthly compliance burden, annual compliance burden that a company has to follow. And of course, higher tax costs. So you will be liable to pay taxes in China under your entity and also on behalf of your employees. So what are the key considerations that we need to consider when you actually do set up your own entity in China? Again, very brief here because it's not the major topic of this discussion. But in the end, I just want to mention that there is a specialized legal entity type, as I mentioned, which is called foreign investment enterprise. It's dedicated entity that can do retail, wholesale. You should be very careful to tell to your to the company you engage for the registration that they should add online sales if you are going to do any online sales, for example, through your website. Or any other ways, because if your business scope doesn't include online sales, and later you will consider to add this to your to the sales channels, you will need to apply for your basically amend your business scope, and it will be pretty costly. So before you actually consider to apply for the legal entity registration, you will need to define what type of products you are going to sell exactly. Import or export or sell domestically. It will be necessary to provide the list of HS codes to the government for the review. You can't just register a trading company without specification of what are the products. Of course, those are the largest classifications and categories. You don't need to go into very deep like classes, but still. The reason the government requires you to do that because some of the products are not permitted to operate or may have some restrictions for the foreign companies to actually bring it in. You may need to apply for additional maybe licenses, or it might be prohibited for foreigners at all to actually operate those products. So this is very critical, and you need to make sure that you select the HS codes on the Chinese customs, since the Chinese customs system is a bit different from the overseas. So make sure you select those. We look at the holding company structure. Generally, this is the key thing before you start to do the structuring, because if you did a bad job, if you didn't consider your holding structure, you may have an issue later when you try to repatriate your profits. Your holding structure will define the tax implications for your dividends, for instance, or if you try to sell it later. Maybe you want to put a holding company in the middle rather than direct investment, because it will be less paperwork to do directly. So holding structure and overall global structure on the top of your Chinese subsidiary is pretty important. Profit repatriation strategies, as I mentioned briefly, it's also critical because you can define different methods, can be just dividends, or you may have a licensing agreement. You can repatriate your profits as a royalty or a service fee. So there are different strategies and there are different tax implications. For instance, if you do it as a service or royalty, you have to pay withholding taxes. So dividends also have tax implications, but it's a bit different. So all of those will require actually a good analysis on the taxes, because you may lose all your margins when you repatriate it out if you didn't do a proper job. And if you are doing the trade between a related party, if you have a headquarter trade in selling any products or services to a subsidiary, and then subsidiary sells it to Chinese customers, you have related party transactions. So naturally, you have to consider transfer pricing as well under this strategy. WOOF is corporate name, as I mentioned, because it might be your brand. English name doesn't have that much of legal power in China as a Chinese name, which will be registered. It's unique. None of the companies have the same names, so it's a unique company for you. It will be in Chinese, and you need to define it carefully. Sometimes misspelling or like just the bad choice of characters make it very crucial for the company, because it may sound weird or funny for the Chinese here. So funding and subscribe capital, another thing that we always look into, and very critical to define the capital to be not underestimated, to have enough capital to run your operations before you become cash flow positive. And there's no limit for the subscribe capital right now. The investor can decide themselves basically how much capital they need to inject, but the government will approve it and they will review your business plan. So based on your business plan, your capital should be covered in at least first, second year of your operations before you get more income from other sources. Legal representative, which is a critical during the post-COVID period. The reason for that is that we currently, that if you do choose the legal representative to be someone at headquarters, and this is often the case because legal representative is a very important role. It's basically the most powerful role under the WOFE, and as a result of that, a lot of companies choose someone at their headquarters. So legal representative will be required to come to China when you open the bank account and potentially for the tax orientation. So currently China bans and basically don't allow any foreigners to travel to China. So if you are in the process of setting up company right now, hopefully it will improve. But currently for this several months, there will be an issue for the legal representative to enter. So there are some local government kind of suggestions that we currently follow for replacement or like another representative on the ground to be able to actually go to the bank instead. But again, this is very, very case by case, and if you don't have anyone on the ground, it might be not possible at all. So we mentioned business scope, WOFE's office lease. Again, virtual offices are still a gray area in China, so we need to have a proper office, at least a small wardrobe for your registration at minimum. The government may visit this, particularly if you're a general VAT taxpayer, they may come and visit your office, the tax officer. And it's also crucial to define the office for the long term. If you're considering to move around and maybe relocate your company after several months, or you want to start with a small office and then you consider to grow and maybe hire more people and then you want to have a larger office, just keep in mind that if you relocate across the districts, you will have to change the tax officer, which means that the current tax officer will be reluctant to relieve you very quickly. So you may have an issue of moving very fast and you will have to wait. So it may create a gap in the ability for you to issue the VAT invoices for your customers. So that's pretty crucial for the trading company. And the last item is a corporate governance. This item is important to follow, particularly for those who are setting up a joint venture. There is a new corporate law, a new foreign investment law, which came into effect on the 1st of January this year. And corporate governance was changed significantly. So there's different structures right now. Those who already have existing JVs will have to make the amendments. So they gave them the grace period for 5 years. For the new entities as well, so you actually need to follow the new foreign investment law. It's a bit more flexible in terms of who can be defined and what are the responsibilities. So this is another thing that we always look into. And this is just a slide to show you the process of the registration. It's not one day like in many countries where you can just basically do it within a day or two, register your entity and open the bank account. It will take several months still, but the process again improved due to new foreign investment law. It's getting more and more faster and easier, although like legal representative issue and travel and issues will have an impact. Let me see. And here I just wanted to show you again, this is not something that we need to deep dive into very detailed, but you need to know that there is a catalog of exported goods and also imported goods. So for specific groups of products and goods that you're going to import, you need to check those. So apart from the licenses that your subsidiary may be required to operate those products, your goods itself may be required to apply for the quota or to apply for some special permits to bring it in. So particularly if you are in some special like food or something, so you need to check that as well, apart from the setting up entity kind of registration licensing. So what are the key takeaways that we probably want to summarize here already on the post-COVID market and for the companies who are looking to sell to China? Basically, that as I mentioned, the trends, pre-existing trends already accelerated significantly. So digital economy was not the new concept in China, it was already in place. And now it's even more advanced, and it's speed up the acceleration and transition to this economy. And not only China, but along the entire Silk Road initiative. And China will continue to actually pursue that. 5G networks are expected to bring a new revolution, and you probably read the media. Everyone is actually trying to share the territory of who is going to, to actually lead that. So 5G will change a lot of businesses from their traditional models. So you need to monitor that, how it will impact your specific industry. Emergency for many new businesses. So contactless businesses and services and deliveries will continue to be in trend even after post-COVID. More e-commerce opportunities like fresh food retail, for instance, acceleration of the healthcare system transformation using the technologies again. China Plus One strategy will be something that companies will continue to look into, not necessarily completely leaving China, but maybe looking at the alternative in case there is something similar to what we saw with the COVID experience, where all of their production frozen for a while. So a lot of companies will consider to either relocate or just to have another subsidiary alternative production plant somewhere in Vietnam or India. Foreign businesses who are selling to China, and particularly those that are actually in China or establishing a subsidiary, will have to digitalize their operation, and only this will allow them to stay competitive. So if you're not doing this, your competition would, and basically you will lose ultimately the market. It's crucial also for the businesses to understand that technologies will be necessary for the transshipment and logistics and warehousing, and as I said, like all the accounting management and financial management. If you are not putting in place the right systems, you won't be able to support your growth long term. I guess that's all as a key takeaways. I'll say a few words about our publishing. Some of you may heard about it. Maybe you see it the first time. Distributor also has a publishing house, which is called Asia Briefing, and we have a great team of editors sitting in our offices across Asia who are producing the wonderful content on everything that we spoke today and much more, basically covering our daily day-to-day legal and financial support to the foreign businesses. We have 7 brands underneath. Here I listed 4, probably most popular ones: China Briefing, India Briefing, Vietnam, ASEAN Briefing. So feel free to go online. You can scan this QR code and you can actually access that. We have a platform, Asiapedia, that allows you to actually find it so easy. And yeah, I welcome the questions that you've sent. I'm not sure how many are there. Probably Maxim was monitoring, but that's all from me.
Hi, Maria. Thank you so much. That was a really, really nice breakdown of all the routes to market for China, especially looking at the cross-border e-commerce and also setting up a WOFE. Lots of information there. We have hit 10:30, but we have a question, which I think we should try to squeeze in.
Okay.
This is from Kirill. I hope I'm saying that right. Apologies. So thank you for the very useful presentation. I have 3 questions. So number 1.
Okay, so it's 3, so 1. 3 in
1, yeah. The first one is just, is the presentation available to download? So I guess we can share the slides with people after.
Yeah. I think you will be sending also the recording, right, with the files, and we will also send the PPT. Yes, it will be available.
Yes, so we will have the recording of this on YouTube after this, and also I think we can share, well, Maria's contact details are here, but we will send a follow-up email and that will have your contact as well if people would like to reach out to you for the slides to download them themselves. Number 2, so which of these 4 options of routes to the China market can increase a faster rate of return? It's a big question.
A faster rate of return. I think it depends heavily on the products, and it depends heavily on the sector specifically. Some of, like, we have clients who sell online and they're perfectly fine with this. Their websites are working fine and they do it from overseas. They don't want to invest more into setting up infrastructure in China and actually invest into like more and more into this. The return is already there, so they don't really need to do that. So yes, direct online sales will be probably the fastest, but for the long term, if as you scale up, as they see more and more demand, many of our clients are coming when they already maybe have sales of, let's say, $1 million renminbi or $1 million US in the scale, and then they need to have a local presence for XYZ reasons which are listed. So they need to actually scale up even more. So if you are looking at the very small scale, direct online sales will probably be your easy, and overseas e-commerce platforms will be the easy way for you to do that. But for the long term, and if you look at the much higher revenue flows, you will need to have a proper presence on the ground for sure.
Absolutely, and as you said, e-commerce and things like cross-border e-commerce can be a really nice stepping stone to the market and to kind of test your brand, how your brand is received and things like that. So yeah.
Right.
Last one, which Chinese province or city are the most foreign friendly? Please name. We want the top 3.
Oh gosh. I'll probably have problems with the other offices later after answering this question.
That's okay. You don't have. We can follow this up in the email afterwards. But
I will tell you that there is no foreign friendly. If you look from the registration perspective, let's put me this way, from the perspective of setting up your business, we see that of course it's natural that first-tier cities will be more experienced, right? And they will be making the process faster. And even within the first-tier cities, For instance, I'm based in Shanghai, and we have districts like Jinan or Shuhui, where a lot of foreign offices already been set up, and foreigners just like set up their entities there. So all the approvals are very smooth because the officers who receive the documents, they have a lot of experience with all kind of different types of industry sectors, regulatory requirements. They have this experience. So, but if we go to the second tier city, sometimes it's a third or fourth tier city. It might be a very good choice for the client as well, because, for example, their production is there. They maybe work on the OEM's agreement with their manufacturers, and all of their manufacturers somewhere deep in the province, and they need entity there. It's actually makes sense from the business perspective, but the local authorities may be less familiar with specific sector or industry, particularly if they are not very traditional, or they are trying to add some activities which are not very traditional. Then it means that we would need to sort of educate the officer, and we will have to bring the cases from other companies with a similar business scope, and kind of give them the examples of other entities already, foreigners already entering. So it doesn't mean that it won't be possible or it's less friendly, just that it may take a little bit more time. Yeah, so, but from their perspective, we actually see that the second and even the third tier cities right now is the infrastructure being created is great, and it's very well connected. It's much better improved than it was in the past. A lot of systems are now connected, like golden tax systems connected to other systems, like, and it's all together. So it's actually simplifies the process. I won't name any specific city, but I would say you would need to consider that from the industry perspective. For instance, if you're going to the south and you're in software and technology, somewhere in Shenzhen, you know that all the software companies are there, and it's just popular for that. So you basically consider from the cluster perspective rather than from the government perspective of being friendly, because in most of the cases it's the same treatment, apart from some very specific sectors which they may not be familiar and have less experience. But then again, this is the job for your lawyers to actually help you to break it through.
Wonderful. Thank you so much for answering all three of those. And on that note, yeah, we're a little bit over time, so I think we'll probably wrap up there.
I spoke to you.
Yeah, no, it was really, really great. That's a thank you from Kirill. I also have a question from Irina about doing a session on Vietnam, but I guess we can address that in a follow-up email afterwards.
Yeah, absolutely. I'm not sure about CBBC, whether you want to change your...
Yes, I'm sure I can definitely help with that.
Your focus, yeah, but we do, and I can follow up with more listing, but on our website, there are under events, I think there are several upcoming under Vietnam already.
Yeah, great. And yeah, as I said, take a minute to scan this QR code, and you can keep up to date with everything Des Anshir will be up to. And we will have all of the information in the follow-up email for you to get in contact with Maria or find out more about Des Anshir and their services, and also to access the recording of this online. And yeah, thank you so much, Maria. Again, thank you to everyone for tuning in.
Thank you everyone for joining. Thank you, Maxim. It's a pleasure.
Thank you for speaking today, and yeah, catch everybody next time. Have a great day, everybody. Cheers.
Thank you. Bye-bye.